Hello everyone, welcome to Brilliant Bankers. Today in our session, we will be going through the topic risks of foreign trade. In our earlier session of Forex, we have gone through the topic the risk in foreign exchange. Those are the credit risk, country risk, currency exchange risk, the legislative risk, political risk, and some other type of risk. So here in this session, we will be dealing about the risks in foreign trade alone. So coming to this subject, what is a risk? Risk is any kind of uncertainty. So any kind of uncertainty can be called as a risk. Risk in human life. Risk is related to illness, impairment or loss of life, but in the same content about the trade in commercial or business activities. The business profit or loss would depend upon how the business is run or how its affairs are managed. So this is what is called risk in a business. So risk refers to a potential for an event or circumstance to result in a loss or harm or undesirable outcome of the business. It involves uncertainty about the future, wherein there is a chance that something may go as unplanned. In various contexts, risk can refer to different type of potential negative outcomes. That is financial loss, physical harm, or the damage to reputation or any other adverse consequences. So risk can be defined as an uncertain event with the financial consequences resulting in loss or the reduced earnings. So risk is what is risk? It is uncertainty of the outcome in a business due to the price risk, the interest risk, currency risk, etc., which we had gone through in the Forex chapter. It is affected by a vast variety of risks other than that of the mentioned risk and the other things which are not there in the domestic market. This is because of its vast arena of operations, wherein the buyer and seller who are located in different countries, the goods and the value of the goods that move in opposite direction, the currency of the country of the buyer and the currency of the country of the seller have their own values which change frequently, while the invoicing may be sometimes in a third currency, which is acceptable to both, wherein there is a change in the value of that currency also. Sometimes it is possible to identify, isolate, and quantify the risks, while at other times it may not be possible to do so. Some other type of risks that will be going through in this chapter are the buyer risk, seller risk, shipping risk, and some more that will be told in detail. So, what is ECGC? It's the Export Credit Guarantee Corporation of India, which was set up in 1957 for promoting exports from the country by proceeding credit risk insurance and related services for the exports. So, what are the types of risk? As we have already told, the buyer's risk, the seller risk, and the shipping risk. So, in foreign trade, both the buyers and sellers face specific risks. This risk can be varying depending on terms of the trades, the nature of the goods and the services involved, and the countries involved. So, what are the risks of the buyer? The risks of the buyer are the non-acceptability, non-payment, the quality acceptance of credit risk, and of the sort. What are these? Non-payment risk. This is the risk that a seller may not receive any payment from the buyer. It can occur due to various factors, including the buyer's insolvency, failure to secure necessary finance, or the disputes over the quality. What is the quality and the acceptance risk? If the delivered goods or services do not meet the quality standards agreed upon in the contract, the buyer may dispute the transaction, leading to a potential dispute and financial loss. The seller is responsible for ensuring that the goods are delivered to the buyer in an agreed upon condition and within the specified time frame. Any delays, damages, or loss during transit can pose a risk to the seller also. So seller's risk comes in the name of non-shipping, poor quality, and the delay in shipment. The risk relates to the buyer's ability to meet other contractual obligations such as accepting goods or specified, providing necessary documentation, or adhering to the delivery schedule. So these are all the risks of the buyer and the seller. To be precise, the seller faces risk of relating to the non-acceptability, non-payment, quality acceptance, and credit risk from the part of the buyer. So this is called a buyer's risk. Any risk that is faced by the seller is called a buyer's risk, and any risk faced by the buyer is called a seller's risk. When the buyer faces the risk relating to a seller not shipping the goods after receiving advance payments, may ship poor quality of goods, and may ship the goods after considerable delay, which may either lead to cancellation or delays in further orders taken by the buyer or even penalties and delays of non-shipment. These are the things in the trade for the risk between of the buyer and the seller. Of course, when the buyer or seller undertake a few transactions and know each other's business and practices and commitments as well, the buyer and seller risk reduced to a great extent. So, what is a shipping risk? Shipping risk in this concept, this encompasses various hazards that goods may face while being transported from the seller to the buyer. It includes the risk like the damage to goods due to accidents, natural disasters, or any other unforeseen events during the transit. Some of the shipping risks are the risk of the intermediaries, the middlemen, mishandling of products, the wrong delivery, goods delivered at another destination, the transshipment risk, attack by sea pirates, etc. Like the risk of intermediaries. This refers to a potential risk associated with the involvement of a third party intermediary in the shipping process. For example, if a freight forwarder or a shipping agent is responsible for handling the goods, there could be a risk related to their performance, reliability, or compliance with the regulations. Regarding the mishandling, the risk which arises when the goods are not handled properly during loading, unloading, or during transit, or improper handling can lead to damage or deterioration of the goods, potentially resulting in the financial loss for the parties involved, both the buyer and the seller. In case of the wrong delivery, this risk occurs when the goods are delivered to a wrong recipient. It could be due to the incorrect labeling, documentation errors, or the miscommunication, resulting in the goods ending up in the hands of an unintended recipient. Where can the goods delivered at another destination go wrong? Similar to that of the wrong delivery, this risk involves goods being delivered to a location other than the intended destination. This could happen due to various reasons, including incorrect addressing, misrouting, or errors in the documentation as it was in the wrong delivery. What is a transshipment risk? This refers to the process of transferring goods from one mode of the transportation or one vessel to another vessel during the journey. This risk pertains to the potential issue that may arise during the transfer, such as damage, loss, or delay in the delivery of the goods. In some conditions, there are the attack of sea pirates as well. This is a specific risk associated with the maritime transport. whenever anything is transported through sea. Sea pirates are individuals or groups who engage in acts of robbery, hijacking, or violence in the sea. Ships carrying valuable cargoes may be at the risk of the piracy in certain regions, as said in the Indian Ocean region, somewhere nearby the African continent, particularly in the areas known for such activities. What are the other risks or the other types of risk? Some other type of risk are like the bank failure risk, where in the case the banks fail for payment, or if there is any insolvency of the bank, in some cases settlement is not done. There is a risk of competition, of issue of fraudulent documents, the price risk, the legal risk, the market risk, etc., could affect the parties to the international trade. These risks can be categorized into credit risk, legal risk, country and political risk, operational risk, and the exchange risk. We have gone through this risk in the initial session of videos of BFM in the foreign exchange chapter. So, what is credit risk? It is also known as a default risk, and is the risk that a party involved in a financial transaction may not fulfill their financial obligations. In international trade, this risk is the most common, associated with the buyer's ability or willingness to pay for goods or services provided by the seller. It can be mitigated through credit checks, trade credit insurance, and the use of the letter of credits. Legal risk refers to the potential of losses due to the violations of laws and regulations or disputes arising from the contractual or legal obligations. This risk encompasses compliance with international trade laws, contracts, import or export regulations, and other legal requirements. It's crucial to have clear, well drafted contracts and to stay informed about the legal frameworks in both the seller's and the buyer's jurisdiction. The country and the political risk involves potential losses due to political instability, government actions, or changes in the policies that can impact trade and the business operations. This can arise from events like the political instability or changes in the government policies or trade sanctions or nationalization of industries. Country and political risk can be mitigated through political risk insurance, diversification of markets, and through research of the political climate in the target countries. So, what is an operational risk? It is a risk of loss resulting from inadequate or failed internal processes, people, and systems, or from the external events sometimes. In foreign trade, operational risk can include issues with logistics, quality control, communication breakdowns, and other factors that may disrupt the smooth flow of the goods or services. A robust supply chain management and quality assurance processes and effective communication strategies can help manage operational risks also. Exchange risk, also known as the currency risk, is the risk that fluctuations in the exchange rates will adversely affect the value of the financial transaction. When trading in different currencies, changes in exchange rates can impact the profitability of the transaction. This can be managed through the use of hedging instruments, the forward contracts, or by denominating contracts in a stable currency. For example, after the goods are exported where the amount is involved in foreign currency, it would result in an exchange loss when the payment is received subsequently. If the home currency strengthens and the foreign currency weakens. Similarly, strengthening of the home currency to a higher extent as compared to the competitor's home currency could result in a better pricing by the competitors and in shifting of orders to the other country as well. What is a country risk? Country risk. International trade is prone to the country risk due to the chances of losses in the cross-border trades, which can be caused by the events in a particular country affecting the profitability of the business or the recovery of trade credits or investments. There could be several reasons leading to the defaults by the buyer due to reasons not within his or her control or the trader's control, but for the governmental, political, economic, or legal reasons of the country. So the RBI has given a guidelines, and that has been prescribed for country risk guidelines for all AD banks or the authorized dealer banks. Banks are required to formulate their own country risk policy and have a system of grading or ratings of the country as per the guidelines that have been given by the RBI. Where banks do not have their own system of rating of countries, they can adopt the country risk ratings of the ECGC. What is ECGC? It is Export Credit Guarantee Corporation of India. ECGC group countries into 7 categories based upon their country risk classification. Banks are also required to make provisions in case its exposure to any one country, as on the balance sheet, is 1% of their more than that of their total assets. So, what are the factors that determine the country risk? Factors that determine the country risk are like political stability, international relations, economic policy, GDP, inflation. So, we will have a brief discussion about the same. Political stability and the governance. Political stability of a government and the political institutions, the presence of corruption, transparency, and the rule of law. The history of political stability or inability include recent elections and the potential upcoming changes. These are some factors in political stability that can affect the country's risk. Regarding the economic policy, the GDP growth and the overall economic stability affects the country risk. The inflation rates and the current currency stability, the unemployment rates and the labor market conditions, and the access to capital market and the availability of financing affects the country risk or is a main factor of the country risk. Regarding the legal and the regulatory environment, business friendly legal framework and protection of property rights is a main requirement. Compliance with the international trade agreements and treaties, clarity and consistency of regulations related to foreign investment, taxation, and individual property helps in a better trade dealing with the country. If in case there's a problem with the foreign exchange and the monetary policies, then it becomes a main factor. Exchange rate stability and potential risk associated with the currency fluctuations is a factor wherein the country where the fluctuations are more, you won't prefer to have a trade in that country. The balance of payment, the external debt, the international reserves, the socio-economic factors, and the infrastructure and logistics of the co- country, competitive landscape, the track record of the country. All of these are the factors of the country risk. RBI has suggested the banks have their own system for accessing the country risk, that is, set their own parameters or follow the ECGC guidelines. However, banks which do not have their own country risk assessment classification can adopt the country risk classification as published by the ECGC. So, what are the classification by ECGC? It is a sevenfold classification which is currently having 239 countries. It updates and publishes the country risk classification on a quarterly basis, and categories are updated as. So, the classification is updated once in every 3 months or 4 times in a year. The 7 different classifications or the categories in ECGC are A1. In this condition, it is insignificant risk, or A2 is a low risk category. B1 is moderately low risk, B2 is moderate risk, C1 is high risk or moderate high risk. C2 is high risk and D is very high risk. So A1 is the least and the D is the most highly risky country for trading in any condition. What is the export credit insurance? Export credit insurance. Exports grow on the backing of the finance by banks. So export credit insurance in India is provided by various agencies to protect exporters against the risk of non-payment and delayed payment by the foreign buyers. This insurance helps exporters to confidently extend credit terms to buyers and explore new markets. How? By providing cheap financing options, by protection against their losses, and the special institution in India, the Guarantee Corporation, the Export Credit Guarantee Corporation of India is the primary government agency that offers credit insurance in India. It operates under the Ministry of Commerce and Industry. Export credit insurance typically covers risk associated with the non-payment due to the commercial and political reasons. These include the insolvency of the buyer, protracted default, political events, and restrictions imposed by the buyer's government. It acts as a crucial risk mitigation tool, allowing exporters to focus on their core operations without worrying about the potential losses due to the non-payment. ECGC also provides valuable market intelligence and information about the various countries to help exporters make information from decisions given by them about which markets to target in the business. Export credit insurance in India plays a pivotal role in boosting the confidence of the exporters, especially those dealing with foreign buyers on credit terms. It helps to mitigate risks associated with the global trade, facilitates market expansion, and supports the growth of Indian export sector. These products are meant specially, specifically for providing risk covers to exporters for any default on their export receivables. In India, too, some non-life insurance companies like the New India Assurance Company offers export credit insurance against the default in receivables. So here we will be ending our session and we have gone through the risks in foreign trade. Next we will be going through the topic role and the products of ECGC and it will be in-depth class on the ECGC, the Credit Guarantee Corporation Limited. Any questions or any doubts in the session can be updated in the comment section where we'll be happy to reply to your queries. I hope the session was fruitful. Do like, subscribe and share our channel.